Hello, listeners. Welcome to the Morning Market Update. The podcast is powered by AI. I am Joe.
And I'm Sarah. Today is February 11th, 2026. Let's dive in. We are starting with a massive shakeup in the U.S. markets this morning. All eyes were on the January payrolls report, which was delayed but finally dropped with a thud, or rather, a bang. Non-farm payrolls surged by 130,000, which completely obliterated the Dow Jones consensus estimate of just 55,000. That's a huge beat, Joe. The unemployment rate actually ticked down to 4.3% when everyone expected it to hold steady at 4.4%. While this sounds like great news for the economy, it's causing some good news as bad news jitters for the indices. S&P 500 and Nasdaq futures are largely pausing as traders realize this strength might force the Federal Reserve to keep interest rates higher for longer. We're already seeing treasuries fall as the market pares back expectations for rate cuts this year. In terms of market breadth, we're seeing a real divergence. Morgan Stanley's Lisa Chalette is making waves this morning, saying she has 100% faded the small cap trade. She's steering clients back toward high-quality large caps, including the Magnificent Seven, because she sees the Russell 2000 struggling in this higher-for-longer environment. Meanwhile, software stocks are looking like they're in the bargain bin after an indiscriminate AI-fueled sell-off lately. Keep an eye on the Dow, which is the only major index showing consistent green in the early pre-market hours, while the tech-heavy Nasdaq remains sensitive to those rising bond yields.
Moving north to the 49th parallel, the TSX in Canada is looking at a very specific set of catalysts today. The big story, not just for Canada, but for the global e-commerce landscape, is Shopify. Their shares are absolutely soaring in the pre-market. They crushed their fourth quarter estimates, largely thanks to a blowout holiday spending season that drove revenues well past what analysts were expecting. Shopify has become the bellwether for the Canadian tech scene, and this one is providing a significant tailwind for the TSX futures. On the resource side, which always dominates the Canadian tape, it's a bit of a mixed bag. We're seeing silver making an incredible move, jumping above $85 an ounce. That's going to be a massive boon for the miners like First Majestic or Pan American Silver. However, the energy sector is caught in a tug-of-war. On one hand, you have escalating Iran tensions providing a floor for prices, but on the other, OPEC is reporting a decline in production from members like Kazakhstan and Venezuela. For the TSX, which is heavily weighted in financials and energy, the combination of a tech rally via Shopify and high precious metals prices might be enough to offset the concerns about a cooling global demand for crude. We'll be watching the mid-cap miners closely today as they react to that silver volatility.
Shifting our gaze across the oceans, international markets are navigating some choppy waters. Over in Europe, the FTSE 100 and DAX are showing some nerves. European wealth managers are under significant pressure today. Their shares are slumping because of fears that AI disruption, which already battered U.S. wealth firms, is now making its way across the Atlantic. On the policy front, Bundesbank President Joachim Nagel has made a bold call for joint European Union debt. He argues this is necessary to make the region more attractive to global investors, but as we know, joint debt is always a contentious topic in the Eurozone. In Asia, the picture is even more complex. The Nikkei had a relatively quiet session, but the Hang Seng is dealing with new data out of China. Consumer inflation rose less than expected in January, and the deflation in producer prices is persisting. This suggests that domestic demand in the world's second-largest economy is still stuck in low gear. Interestingly, Hong Kong is forging ahead with its own crypto ambitions despite Beijing's disapproval. The Monetary Authority just issued its first batch of stablecoin licenses. Down under, the Australian market took a hit as biotech giant CSL plunged to an 8-year low. Their CEO, Paul McKenzie, is stepping down, and their earnings were weak, which dragged on the entire ASX. And in India, the Nifty 50 remains resilient but cautious as global traders weigh the impact of a stronger US dollar on emerging market liquidity. In commodities, watch cocoa, traders in the Ivory Coast are actually halting purchases because they're waiting for prices to drop further after a recent market rout.
Let's get into some of the heavy hitters in the corporate world here in North America. We already mentioned Shopify's triumph, but it's not all sunshine in the tech sector. Astra Labs is seeing its shares sink by 10%. Even though they technically beat consensus estimates, their revenue guidance came up short for some, and the big blow was the announcement that their CFO, Mike Tate, is stepping down next month. Markets hate uncertainty in the C-suite, especially when it's the person holding the purse strings. Then we have Robinhood. It's a tale of two stories there. Their stock took a hit on earnings, but they've just launched the public testnet for the Robinhood chain. They're trying to pivot hard into compliant, always-on-chain finance. It's a risky bet, but they are clearly trying to move beyond just being a retail brokerage. In the consumer space, McDonald's is facing a bit of an internal rebellion. The company is doubling down on its value strategy to keep traffic up during this inflationary period, but franchisees are pushing back. They want the independents to set their own prices as their own costs rise. And finally, keep an eye on Ford. They're part of the morning squawk today after earnings showed that while the transition to EV is still a money pit, their legacy combustion and pro-fleet businesses are essentially keeping the lights on. It's a stark reminder of the two-speed economy within the auto industry.
Looking at the international corporate landscape, we're seeing some fascinating moves, particularly in the energy and finance sectors. Total Energies is making headlines this morning for essentially snubbing a potential geopolitical shift. They've addressed the Trump-Venezuela dream, calling the prospect of returning to Venezuelan oil too expensive and too polluting. Total Energies exited the country in 2022 to move away from heavy, high-sulfur crude, and they've made it clear they aren't going back, regardless of U.S. policy changes. Speaking of energy, ADNOC, the Abu Dhabi National Oil Company, is aggressively expanding its LNG tanker fleet. They're ordering up to 6 new vessels as they try to transform from a regional producer into a global gas trading powerhouse. They clearly see LNG as the bridge fuel of the next decade. In the UK, BP is under the microscope. They've decided to retreat on some of their payout plans, which sets them apart from their big oil peers who are still showering shareholders with buybacks. The market is questioning if BP can actually deliver on its turnaround strategy without that constant flow of dividends. And for something completely different, the Vatican Bank. They are making their first foray into equity indexes. They've launched 2 indexes tracking 50 stocks that align with Catholic teachings. It's a major push into the retail investment space and could lead to the first ever Vatican ETF. It's a sign that even the most traditional institutions are looking for ways to capture the shift toward values-based investing.
On the macro and geopolitical front, things are getting a bit tense. President Trump and Prime Minister Netanyahu are set to meet in Washington today, with Iran at the top of the menu. This meeting is a primary reason why oil prices are holding steady despite data showing a potential supply glut. The market is pricing in a geopolitical risk premium. At home, we have a bizarre situation in Texas. The FAA has closed the airspace over El Paso for 10 days, citing special security reasons. They haven't given any details, but it's halted all flights in and out of a major border city. This is happening right as a tariff bill showdown is brewing in Congress. GOP defectors just helped spike a measure that would have blocked challenges to Trump's tariffs. And we have to talk about the U.S. dollar. The greenback has dropped 9% against a basket of currencies over the last year. President Trump has actually given a thumbs up to this weaker dollar, as it makes U.S. exports more competitive, but it's creating a massive headache for international trade partners. When you combine a weakening dollar with that 130,000 job beat we mentioned earlier, the Fed is in a very tight spot. They have a hot labor market, but a currency that's losing its edge.
To wrap this all up for you, here are the 3 key takeaways for your trading day. First, the U.S. labor market is far more resilient than anyone thought. That 130,000 job print means the pivot to rate cuts is likely getting pushed further into the second half of 2026. Second, the quality trade is back. With small-cap software and biotech firms getting punished for any slight earnings miss or AI threat, the big, cash-rich companies are where the smart money is hiding. Third, keep an eye on commodities and the dollar. With silver at $85 and the dollar index at multi-year lows, the traditional inflation hedge assets are starting to scream for attention. Whether you're looking at Shopify's growth or the Vatican's new index, the theme today is focus on the fundamentals because the macro environment is getting very noisy.
That wraps from today's update. I hope you gained useful insights into these global shifts.
Add your thoughts in the comments and follow for more such updates. This is Sarah.
And Joe, signing off. Have a profitable day, everyone.